Today, what I even want to talk about is C2 closure, right? Because it is the C2 closure that we are going to look at to know if you will trade the continuous candle or not, right? So everything starts with the C2 closure, right? So we are going to look at some validations of it and some invalidations of it before we even talk about the indices model. Right, network lagging or something like that. What's happening? Okay.
Hey, can you hear me?
Yes, I can hear you. Can you also hear me? So my network was lagging a little bit. Can you hear me now?
Yeah.
Can you hear me? Because I don't know, it's about to rain over here, so I don't know if that is what is causing the network to be this way. But can you hear me well? Hmm. Hello, Aidan, can you hear me?
Yeah. Yeah.
Can you hear me now?
Yeah, I can, yeah.
Yeah, can you hear me now? So I'm sorry. You have to like bear with me. Do you get it?
Yeah.
Yeah, you have to, bear it. I myself, I don't know why. A minute. Okay, so let's get to it. Can you hear me now? If I want to explain some stuff.
Yeah.
Okay, cool. Okay. So for you to even trade the third candle, you have to get a perfect C2 closure. When you talk about a perfect C2 closure, that is when the C2 candle closes inside the range of the previous candle. So when we talk about the range, this is the range, right? So you have a range this way, and then the C2 candle closes inside that range. Then that is the market telling you that it wants to go lower, and that is the reason why it failed to close over, and instead it closed inside this way. So based on that, you can say the third candle is going to open and then distribute down the next day, right? And the simple target is going to be your previous daily low. So if this third candle also closes over the previous daily low of the second candle, then you can focus on trading the third candle, which I know you already know of, right? So now one invalidation of the C2 closure is when C2 comes and then it takes both ranges of C1 this way. In this way, you do not really know where the market wants to go, right? It looks as if there's some kind of manipulation or something, right? So in this way, when this happens, you have to wait for more data to know if the market is willing to really move or not, right? So let's say you have your fair value gap over here. You have your fair value gap over here, and you want price to move to the next external range liquidity. But then, you get this invalidation, right? You get something like this. You can't know what the market wants to do. Although the market is moving from a fair value gap to external range liquidity. But then the candle closures should also tell a story, right? Because the market is always telling you a story. So if it forms this way, you just have to wait for the third candle to print, right? And if the third candle prints and then it closes over the second candle low this way, then if your external range liquidity on the daily time frame or whatever is still intact, then you can say based on that the following candles will distribute there, right? So the next thing that we're also going to look at is if a C2 closure forms this way, right, you can expect C3 to be a continuation. because here we took this candle and then we closed over, right? It's just the same as we closing within it, right? Because as we are even closing over, it also shows that the candle is indeed willing to go down. So you can focus on trading the third candle, right? And sometimes you not get a C2 closure this way, there will be the presence of SMT. So I don't know if you were the one asking me about SMT. You can add the SMT to your model. It depends on you. But I sometimes don't look for SMT. But you can also add SMT to your model. You can be like, if there is no SMT, you are going to wait or whatever. You get it. It all depends on how you want to trade. But it's not really that important that without SMT, the market will not move. Do you get it? Yes. So
Yeah.
now, is there any question based on what I just thought before I move on?
No.
Okay, so for indices, right? For indices, when you're trading indices, your focus should always be on the 930, right? That is when you should be looking to take your trade. So when you get 930 this way, usually during that 930 time frame, there is a manipulation, right? And when the market manipulates, it targets smooth edges. So when I talk about smooth edges are just like a consolidation, right? So if you have a consolidation this way, now if you have a consolidation this way, if you look at this upper part, you can see that the market is failing to take this high. This one came, failed to take this high. This one came, failed to take this high. So the market is building liquidity on these levels, right? So during 930, you see that even without you even applying bias, during 930, you can just look for smooth edges, right? And then during 930, you wait for your manipulation. And let's say that manipulation into a higher time frame key level. And this key level can be the 4-hour time frame key level or 1 hour time frame or 15 minutes. So let's say there is a 4-hour or 15 minutes or 1 hour. Because if you spot a 15-minute key level, you can go to the 1 hour time frame to see if there is something there, and also the 4-hour time frame to see if there is something there. You get it? Just combining time frames. So when you wait for your manipulation, you can go to the 1 minute time frame to look for your CISD, and then you target those smooth edges. Now those smooth edges becomes A plus when the Asia section forms part of that smooth edges, right? So let's say that there is a smooth edges over here and it happened during Asia section. That is A plus liquidity. But it doesn't mean that if there is smooth edges, the market will not go for it. The market really loves smooth edges, right? And whenever you are targeting your drawn liquidity and there are smooth edges, then that is A plus, right? Because smart money do this to build liquidity and later they will manipulate to come and take that liquidity. So even if you want to wait for 930 opening, you are still going to use candle closures, right? You are still going to use that. That means that you focus on, I think, because it is 2, 6, and 10, right? So you focus on the 6, right? Because if 930 manipulates, then 10 a.m. will distribute. So let's say that you go to your 4-hour time frame, and then although you are getting your candle closure this way, or let us say that you've had a candle closure this way, this was 2 a.m., right? So when the 6 a.m. opens this way, some people will just focus and trade the 6 a.m., right? Like how they trade Forex or something like that. But for me, even if the 6 a.m. candle opens and I think it should distribute down on indices, I will still wait for 930 to happen. That is when I look to take trade. So when I'm trading indices, I just look at 930. Do you get it? To take trade. So
Yeah.
so I already have my bias. I know where market wants to go, right? So at 930, I just position myself. Sometimes the 930 will even be just as I was saying, even without a bias, you can just port your smooth edges, wait for your 930 manipulation, and then target those smooth edges. And then it becomes A plus if Asia section is part of it, right? So now what we are going to look at is, let's say on your daily time frame, you've had your C2 candle perfect closure, right? So you want to trade C3. You can see that whenever you get these closures, when you go to the lower time frame, you get to see, or when you go to the 4-hour time frame, you get to see that the schematic that is on the 4-hour time frame. So you minimum by bill. Yeah, I had a call, and I mean that caused that. So whenever you get, can you hear me?
Yeah.
Whenever you get these candle closures on the daily time frame, you can see that when you go to the 4-hour time frame or even the 1-hour time frame, you get to see a market maker model is presenting itself. So you get to see something like this, where smart money will first buy to build liquidity, and then later on they will start selling to attack those liquidities. So whenever this low fails to take this low fails to take this low, this is what we call low resistance liquidity. And when we take a low, or when you rate a high, that is what is called high resistance liquidity. And the market always moves against low resistance liquidity. So when you get to your C2 closure, you go to the 4-hour time frame, you're going to see a market income model this way. And then you get to see that maybe ICT 2022 model will present itself. You get your fair value gap, and then you can take your trade from there. So anytime you want to, you are kind of confused or something, or you want to really understand the schematic behind this C2 closure or reversal signature, you can just look at the bigger picture. That is the market maker model, which I know you know of. And in that same way, if you see this, you wait for this on the 4-hour time frame too. You go to the 15-minute time frame, you're going to see a market maker model on it, right? So let's take a look at some examples on indices and see what we can do. So let's go to the daily time frame. And I can say we can use this other block over here to frame our trade, but then there is no fair value gap in this leg. Usually, I want to see a fair value gap. I mean, fair value gap shows that smart money is involved in that price move, right? Usually, I want to see a fair value gap. So currently, let me take it back to maybe start a new one to around this area, right? So around this area, I can clearly see that we took this external range liquidity and then we went up, right? And we have this volume gap, we have that volume gap, and it looks as if down close candles are also supporting price to go higher. The market is respecting bullish PDRAs. The market is disrespecting, sorry, this was a bullish PDRA. They all got disrespected. Okay, let's go to the weekly time frame to see the bigger picture. Okay, so let's see the weekly time frame, right? So on the weekly time frame, you can clearly see that we're in a bullish trend, right? Can you see it?
Yeah.
And then we can see that down close candles are supporting price to go higher. And over here, there is this volume gap that's on the weekly time frame we are reacting from. There is also this volume gap that is serving as inversion or whatever. Okay. So the bigger picture is bullish. Okay, so let's go back to the daily time frame. So on the daily time frame, right? Well, let's just look at this, because over here, okay, let's just move price forward. So I want to get a clean price action. Okay, perfect. So we had, maybe there was some kind of SMT over here that respected this bearish PDRA. You can clearly see that here the market is disrespecting these bullish PDRAs, right? And the market printed a bearish PDRA. Maybe there might be some SMT over here that is supporting price to go down. And we can clearly see that price is reacting off this FEG, and then it's giving us a C2 closure, right? So if you get this C2 closure, if you go to the 4-hour time frame, you get to see that this is, or the 1-hour time frame, so that we can get the bigger picture of it. You get to see that it's a market income model that is presented itself. So let's go to the 1-hour time frame. Right, so if you go to the 1-hour time frame, this is it. Or let's even use the 15 minutes so that you can see it well. Yes, so if you look at the 15 minutes time frame, you can clearly see that we are in the market maker model. And then we've had the reversal, right? And then we have this was, you see, if we are to ignore this, well, this wasn't even smooth edges. I want to use this to explain smooth edges to you. Let's see if we can see some smooth edges. Smooth edges, smooth edges. Well, these are all low resistance liquidity because this low failed to take this. This one. Was this a swing low? Yes. Okay, a minute. So this is an example of a smooth edge, right? Do you see it kind of consolidated? Do you see it?
Yeah.
So that is an example of a smooth edge, right? So you can clearly see that that candle closures that we are talking about is a market maker model. If you're looking at the large view, it's a market maker model. That smart money was building liquidity over here that they are later going to attack, right? So now that you are getting that perfect C2 closure, you want to focus and trade the third candle. Now, to trade the third candle on the 4-hour time frame, we are getting a displacement, which is very beautiful. Which shows that smart money is involved in the move. You then wait for your C2 closure on the 4-hour time frame. So let's see if we get any C2 closure. It looks as if we just went. Okay, so what time was this? Okay. Yeah. What time is this? 5, 9. Okay. So you can clearly see that currently, if you are even looking at this, you realize that this one kind of formed the C2 closure, but it wasn't perfect. Can you see it?
Yeah, which one?
This one.
The 17 one. The
Yes, the
17
17
o'clock
one.
one. Yeah.
You can clearly see that it didn't form a perfect one. And then you wait for more data, you can see that this one formed a perfect one. But when this one formed that perfect one, it took this external range liquidity. So now that we are taking that external range liquidity, it should tell you that the market is, and then we also respected it. It should tell you that the market is likely to reverse. Since we tag a fair value gap over here and then we closed over this up close candle, that is some form of change in state of delivery over there. Do you see it?
Yeah.
So now you can clearly see that if you go to the lower time frame, you can see that the market is kind of building liquidity over here so that it will wait for 9:30 manipulation and maybe target that kind of liquidity. So let's go to the 15 minutes time frame to see what is happening over there. So you can clearly see that we are building liquidity. Do you see it? Do you see how the market is doing it? So now let's mark our 9:30 opening. Even without bias, right? When you come to this market and you look at it, you can see that this place is more smooth. I think we have, okay, this is not, you see there is a high resistance liquidity because this low took this one. From to market with a vertical line. can see that we've taken it. So why should the market come here? Because liquidity is already being raided. So 930 will manipulate and then attack liquidity. So let's see how it will happen. Okay, so let's just see if it will go for that smooth edges out there. Sometimes there might be SMT, right? Mostly you should always look for SMT. When there is SMT, then on its correlated pair, then you shouldn't expect price to go there, right? So let's just wait and see. I just don't know. We might then look for SMT. I think it went into the next day. Sorry. When was 10 a.m.? Hey, wow. That was 9:30. So 9:30 went up, took that, didn't tag this. No. So I think there might be some kind of SMT over here. Let's look at the 4-hour time. And you can see during 9:30, volatility came into the market, right? But I think maybe there might be SMT over here, which we are going to. Let's look at it correlated. Let's look at the daily time frame. Okay, so let's go back. This was fine. And this is also fine. Let's look at S&P 500 because I don't know why S&P 500. S&P 500. This one. Where was it? This one. Okay, so let me explain something real quick to you. Okay, so let me see how the volatility of 930 will happen on the 1 hour time frame. This was 11, 10, 11. So 10 plus 4 is going to be 14. So the next, okay. So let's see. This was what? 16, 15. So it finally went for that smooth edge, right? But it didn't happen on the day we wanted it to. It didn't happen on that day. And that's why I want to find out if there was some SMT on those highs. If there is SMT on those highs, then that will no longer be a smooth edge, right? So you always have to look at that. Okay, so this is the give us SMT. This high, this high, Those highs, these highs. This one. Okay. There was no SMT over here. Why didn't 930 just manipulate and go there? Let's see. So the market 930, I think 930 manipulated to take this external liquidity, right? So you let's go to the 1 minute time frame and let me explain some stuff. Huh? Okay. Hmm. Let's wait for 930 to see. Oh, can you hear me? Hello, Aidan, can you hear me?
Yeah, yeah.
Yeah. Oh, very, very sorry for the network. Very, very sorry. So let's see how it will print over here and it delivered. Okay. So we went down from the CISD, came back from another CISD. So that 930 manipulation, leaving all these low resistance liquidity over there. This one is what? Okay. So let's see how he expected 3 a.m. distribution. So I don't know. I don't know how why this day formed that way. I don't understand what happened. I don't know how I would have traded that day. I just don't know. I just don't know how I would have traded that day. Oh, let's go back to the daily time frame. Let's go to the farm. Let's see. I just don't know how I would have traded this. So let's move to the next. I just don't know how. Let's see if we get a clean 930 manipulation somewhere. Or let me use candle closures. The minutes. Let me go down to the 15-minute time frame and first teach you the smooth edges concept. The one that in case you are confused, you can just locate where the smooth edges is. Wait for 930 manipulation and then trade towards that. So let's allow this. And it's a bonus if the Asia section is part of that smooth edge. Okay, so nice one. I hope we don't attack. Also, we took them. Let's just see. Let me mark it with a vertical line. Okay. So we can clearly see that 930 manipulated now. And then it took, did it take this external range liquidity? Yes, it took this external range liquidity, right? So you see the manipulation took that external range liquidity. And then we have these smooth edges over here, this low resistance liquidity. So price might go for those ones. And you can clearly see that the market distributed and took all those low resistance liquidity, including this one. So even if you are confused with your buyers and you don't know where the market is going or the market is not giving you candle closures, you can just port the smooth edges, right? If there are smooth edges, you can just port them. You can see the market maker model happening, right? Where we are building low resistance liquidity. We had that 930 manipulation. It took this external range liquidity and then we distributed. That means that the previous day, it just, you wanted it to first move down and then attack those smooth edges. It's rather moved up and then came down. So it will be best to avoid it. So let's see what to continue to do. This one was what? Okay, so outside kill zone now. So we can see that when 930 manipulated, the 10 a.m. candle distributed, right? So how would you have traded this? Let's go to the 1 minute time frame. Like most of the trade I took and share with you. This is how I took it, right? Most of them I didn't. Sometimes I don't get the C2 closure, but I still want to take a trade. This is how I do it. So we can clearly see that we came down, formed that CISD, and then price took from there. And you can see that if you're to place an entry, you see the number of pips that would have given you, right? Sorry. Yeah, so we'll meet on Monday to trade on US 100, right? And if we don't
Yeah.
get a C2, so that we can do it live with economic calendar for me to teach you the one you do not even require any buyers to do it. Like if you don't have, you are confused, you can just do it this way. So is there any question?
Um, no, I can message you on Telegram
Okay, okay,
if I
okay,
have a question. I
okay.
think this meeting is gonna end soon. It says uh like
Yeah,
it's
yeah,
gonna
yeah.
end in a minute.
Okay, okay. So I will send you the recorded video.
Yeah. Okay, cool. I'll give you a message on Telegram.
Okay, okay.